Okay, great. Hi, welcome everybody to today's session, which will be our third series targeted to beginners called Personal Finance from Mystery to Mastery. Before we get started, wanted to just remind you of some of the logistics. If you have questions at any time, just feel free to put them in the chat and we'll address them during the Q&A sessions. So the presentation will be roughly 30 minutes or so, and then we'll handle questions after that. So great. And the last logistical thing I wanted to discuss is there is a possibility we might be doing a web seminar for small case members, not Barossa small case only, but all small case members. So if that gets set up, I'll send out a message on the WhatsApp group to those of you on it on how you can dial into that web seminar as well. We're going to be doing a very interesting talk on what causes market crashes and what we can all learn from them and how we can protect our returns from learning about what causes the crashes. So that'll be a really good session and very topical. So great, let's dig into today's session. So first, I want to just review very quickly what we covered in our last session. Now, for anyone that hasn't seen last session or wants to see our whole library of videos, the best way to do that is to go to our YouTube channel. Anita will send a link in the chat for all of you if you would like to join the YouTube session and the YouTube channel and subscribe. It's the best way of staying on top of all of our videos. So last time, what did we do? So we finished the savings pillar. We talked about the 3 traps that get in the way of proper savings and how knowing about these traps can help you optimize your savings in a better manner. We also discussed how to enjoy while still making your savings targets, right? So essentially not being too focused on just hitting these rules in an arbitrary manner, but forcing yourself to sort of make trade-offs in your life. And then we concluded the first pillar and we reviewed our key recommendations on savings. And then we learned how savings builds the foundation for our next pillar, investing. So essentially, when you save, you've done the hard work of creating excess money for yourself, right? That's what savings are. They're money that you have that you're not using. And this money has value. And investing is all about how do you unlock that value and how do you make it grow over time. And so that's what we're going to start introducing in today's session. My guess is covering the entire investing pillar will take us about 3 sessions is my guess, including this one. But it'll be fun and it'll give you a lot of confidence that you can manage your own investments and you don't need to rely on someone else's advice. So what are we going to cover today? We're going to cover what investing really means, why investing is a must, and understanding the key tenets of investing, which comes down to risk versus reward. And then we're going to understand what financial compounding is. You may have heard this term, but what does it actually mean and why is it important? And then we're going to prep for our next session on just learning a little bit of jargon that's commonly used in investing that we're going to deal with more fully in our next session. So what is investing? So like I said, you've saved a bunch of money, right? Now, where do you put that money? What do you do with it? How do you earn a return on that money, right? So investing is all about answering that question. You've done the hard work of saving. Now you get the fun part of trying to create profits through your savings. And that's kind of what we're focused on in investing. So we have a very simple rule to identify what an investment is and what an investment is not. An investment is anything where you can park your savings for some time in the expectation that it will increase in value over time. So this is a very important part of the definition of an investment. Whatever you park your money in is only an investment if you expect that to appreciate over time. That doesn't mean that it necessarily will appreciate, but you at least expect it to appreciate. So I've just given you a few examples of what common types of investments are, and other things which are not investments, right? So stocks and bonds, when we buy a stock or bond, we expect that we will earn profits from that investment. So we expect our value will increase in that over time. Real estate, when you buy a house, the house value tends to go up over time. That's an investment. Something like education also, for example. Education is an investment in yourself. You're taking money, you're spending it on learning some skills in the hopes that you'll earn more money than what you spent on the education. So that also is an investment. So like what aren't investments? Like let's say you buy a car. So a car is not an investment. Why? Because you're almost guaranteed that the car will lose money over time, right? Because new models will come out, your car will get mileage on it, so it loses value over time. It's not an investment. Consumables, a TV, for the same reason, is not an investment. Just simply taking your savings and sticking it under your mattress or not investing it is also not an investment because it doesn't increase in value over time. So that's a very simple rule you can use to identify what an investment is and what isn't an investment. So why is investing important? Why do we have to do it? Because we all know there's some risk in investing, right? We know there's a risk that you lose money or you don't get an outcome that is great. So why do we have to invest? Why can't I just take my money and stick it under a mattress? Isn't that simpler and safer? This is a strategy that is guaranteed to cause you to lose real money over time. Why is that? Because you may have noticed that the price of things tends to increase over time. So I've just given you one example here. So milk was 16 rupees per liter in 2007. Today it's 39 rupees per liter, right? So look at the increase in milk prices. And this is just one example. If you look at any goods, the price of a book, the price of education in college, we all know that prices increase over time, right? And this tendency of prices to increase over time is called inflation. And what I've done here is I've given you a little chart, right, which is IMF data on the average annual increases in price in India. So how much does a basket of goods increase in price over time? And we'll see that roughly in India, the inflation rate has tracked at greater than 5% per annum, right? So that means if I just take my money and I put it under my mattress and I go to sleep, right? Every year that money is becoming 5% less valuable because it's not growing. It's just sitting there and the prices of everything are rising around me. So why does inflation happen, right? I mean, it's something that we see in the economy, but it's not clear to us why that's the case. So I just wanted to give you a little understanding of why it tends to happen in an economy. So we all know that our economy is growing, right? So we're posting GDP growth, etc., over long periods of time. And so people are getting wealthier. And when people get wealthier, they want more goods and they can afford to spend more on goods, right? So that tendency causes demand for the goods to grow faster than supply. And this is not every year, year in, year out. Like you'll see in the US right now, there's actually deflation that's happening. But the tendency over time is for demand to grow faster than supply, which pushes prices up over time in an economy. And this is our greatest enemy when it comes to protecting the value of our savings. So to protect the value of our savings, we have to grow our savings also. So actually, if we did nothing, our savings would be half as valuable in 15 years based on a 5% inflation rate. So that's kind of what we're working against and why investing is so important. Okay, so let's explore the potential costs of investing versus the potential reward. Right? So what's the cost? The cost is you could potentially lose some money in investing, right? We all know that every investment comes with risk. And why is that? Because you're giving your money, your savings, and you're making a bet that you're going to get more back in the future. But there's uncertainty, right? And every form of investment has some element of risk. The risk could be very, very small, or it could be very, very big. Right? So let's say I put my money in HDFC Bank and I'm getting a savings rate of, let's say 4.5%, 5%, right? Now, my return is that 4.5 5%. Now, if for whatever reason HDFC Bank runs into trouble or whatever, they may not honor my deposit. I'm always taking that risk. Now, that risk is very, very small, but it does exist. And so, the important thing to realize here is any investment has some element of risk. And the type of investment will vary in how much risk you're taking. And that's going to be a key thing that we're going to discuss as we evaluate investments. How much risk am I taking in a particular investment? Now, the reward. So the reward is basically how much money you expect to get in the future. And this also tends to vary in different kinds of investments. So if, like I said, if I'm putting my money in a savings account or an FD, I'm probably going to get 4.5 5% return over time. That's going to offset my inflation, but it won't help me grow my wealth, right? But if on the other hand, I put my money into some risky bonds, I may get a 10% interest rate, 11% interest rate, but I'm taking more risk, right? So we always want to balance the reward of an investment versus the risk of an investment. So if you understand this trade-off, risk versus reward, that's really going to be our main tool as we analyze how good an investment is for a particular person. So I want to cover something called the principle of risk and reward matching. You can think of the market for investments as any kind of market. So what does that mean? We're all looking to find investments for our savings. And we all have the option to put them in different things. You can think of these things as dukans, right? That are all selling their own type of investment. And it's my job as an investor to decide where I'm going to put that money. But like any market that works well, the chances that you find a bargain are very, very slim. So the principle that I like operating with when I analyze investments for myself, if something looks too good to be true, it probably is. So we should always take a very close look. If something looks like it is giving very high returns, it's probably taking some risk somewhere that you're not understanding. Bargains can be found, but they're very, very difficult to find, and they require a lot of work to actually find. So the principle that you should use in investments is just assume that there is no free lunch, and that mainly everything is priced correctly in the market. That means that level of risk is related to how much reward you can earn from it, right? So this means as a beginner, we should be much more focused with understanding the risk than understanding the rewards. Because if the market is working correctly, if you understand the risk, the reward will be tied to how much risk you're taking, okay? So that's kind of how we're going to learn in this course. Okay, so what is compounding? You all may have heard this term before, financial compounding and all this stuff, but I want to cover what it really means. So it's basically just a description of how something grows. So you really have two forms of growth that we typically see in the world. One is linear growth and the other is compounding growth. So linear growth describes things that grow a fixed amount every period. So let's say that I earn a salary, my salary is fixed, and every period I save the same amount of money under my mattress. My mattress savings are gonna grow linearly. Every, let's say month, when I collect my salary, I put the same amount in my piggy bank and it grows like a line in a linear fashion, right? So that's one form of growth. So examples are how much I earn working at a fixed wage rate per hour. Every hour I make the same amount of money. My growth in savings, if I save a fixed amount and I don't invest, those are examples of linear growth. Now, compounding is much more interesting. It describes things where a little growth results in more growth because you grow on top of what you grew in the past. So this results in a compounding effect, a cascading effect that makes growth accelerate over time. So there's some really good examples because our world tends to be a compounding growth world. So think about population. India's population growth is a perfect example. Look at how quickly that's grown over time. It's growing because every new person in India is also going to potentially have a probability of producing another new person at some point in their life. So if you grow, little growth results in more growth over time, right? COVID infections is another example. We're seeing the painful consequences of how quickly COVID is growing, because when one person has the virus, he tends to spread it to 2, 3 other people, right? So these viruses can grow very quickly because a little growth results in a lot more growth later. So compound growth typically describes anything that grows a fixed percentage every period. So if something grows by a percentage term, because it grows on growth, we'll see compound growth. So our investments tend to compound. Why is that? So our investments generate income for us, profit for us, which helps us invest even more and generate even more income, right? So it's a phenomenon where a little growth results in more growth. And that, as we discussed, is a recipe for compound growth. Also, as we discussed, the world is compound in fashion. So our investments mirror the economy, and the economy is dependent on how quickly our population is growing, how quickly technology is growing, and how quickly our GDP is growing, right? So because a little bit of technology helps you get a little more technology down the line, even the rate of technological change is growing in a compound fashion. So this is a compound world, which is why our investments also grow in a compound fashion. And this is something that we as investors can take advantage of, because it's really amazing how this adds up over a long time. So what I'm showing you here on this chart is the value of 1 rupee invested over time. So in this case, different amounts of years and different rates of growth. So we can see that if something's growing 10% a year, in 30 years, my 1 rupee is worth 17 rupees. It's grown 17-fold. And my 15% growth is grown 66 times. So essentially, what starts off as a little growth turns into a lot of growth, right? So what are the key takeaways on compounding? One is it takes time for values to diverge. Look at the table here, right? All of the values are 1 rupee, even when you get out to 2 years. It's only after you get to the 3rd year that you see the 15% column growing to 2. So it tells you that compounding takes time for the magic to happen and work. But when it starts happening, the growth is mind-boggling. So time and consistency are the key, which is why enormous wealth can be created if you manage to grow your investments at a decent rate. It doesn't even need to be super high. It just needs to be higher than inflation. And you do it consistently over a long period of time. So you need patience, you need a high savings rate, and you need to be able to invest those savings in a fashion that gets you returns greater than the inflation rate. So what's the value of the extra 1 rupee I saved in 15 years? Well, if I didn't invest it, it may actually decline in value because of inflation, right? It may be worth 50 paisa if the inflation rate is 5%. If I do invest it, then even taking into account inflation, my 1 rupee will be worth 2 rupees, which tells you also that how much you save today, if you're investing properly, is actually worth a tremendous amount later. If I can grow my investments at 10%, if I save 100 rupees today, I'm talking about saving tons of money, 1700 rupees in 30 years, right? With just investing that money. So that's the magical power of compounding, and how putting together savings with investments can result in an enormous amount of wealth. So what I'm going to be focused on in this series when we talk about investments is I'm going to be focused on a very particular style of investing. So I'm not going to be focused on this right-hand side of the page, okay? So I'm not going to be focused on finding and telling you guys how to find bargains in the market where you can earn very high returns and take very little risk. And the reason why is this is not the goal of this series. We have another series called Stocks Zero to Hero, which gives you a flavor of how to do that. It requires a lot of work and a lot of analysis, and it's not appropriate for 90% of people because they just don't have the time to do it. They don't have the interest to do it. and it's not worth it. And I'll show you that on the next slide for most people. So I'm not going to be showing you that in this series. Instead, what I'm going to be showing you in this series is how 90% of people should invest their money, which is determining how much risk they can take and putting their money in the right investments for them based on how much risk they can take and their specific parameters. That's what we're going to do. And that's good enough. And I'll show you why that's good enough. So what I'm showing you here is the difference in the two approaches in the US stock market over a very long period of time. So the line in blue is the strategy of just getting market returns. Remember what we said about the market, right? Usually things are priced correctly, right? And so the key is just looking at the amount of risk you're taking and assuming the returns are priced properly. The other approach is bargain hunting and trying to find the excess return in the market. So the blue line is just putting your money in the market. That's it. The orange line is actively managing your money, meaning I want to buy this stock, I want to buy that stock, and trying to find better stocks than the market. And what we found looking over long periods of time is that the average active fund underperforms the average passive fund over a long period of time. And that sort of makes sense, right? You will have the occasional person that can beat the market, right? There's some exceptional investors like a Warren Buffett that have managed to do it, but they're very rare. And the average investor is not going to be able to do that, right? So they're actually going to underperform the market when you take into account fees and all these things. So it's very important that if you're not going to put in work into and lots of work into trying to beat the market, we recommend you just take a passive approach and just search for the right types of investments for yourself. And you'll do much better over the long run on average. Okay, so now I'm just going to conclude this session with a little bit of terminology that's going to prepare us for how we're going to think in the future sessions, right? So some vocabulary that I might be using, and I don't want you guys getting confused if I start using these terms. So the amount you invest, we're going to sometimes call that your principal or your capital that you put into investment. Okay, so that just means how much money did I park in the investment? That's it. The amount you get back, okay? And I apologize for all these different terms. Finance is full of jargon. You're just gonna have to get used to it over time. And don't worry, I'll try to remind you of what these terms mean as we go through this. But so the amount you get back is sometimes called return. So that's what is returned to you when you sell the investment or the investment matures. And that is usually expressed as a percentage of what you invested. So if I put in 100 rupees into an investment and I got back 200 rupees, then my return is 200%, right? Sometimes it's also actually viewed as a multiple of that. So you subtract off 100% also. So sometimes you can also say it's 100% return on the investment. There are two conventions of doing it, right? So then the IRR is your return expressed on an annualized basis. So maybe I put 100 rupees into an investment and I got my 200 rupees in 5 years. So the IRR just tells you what your average return was over each year. And we look at these things because it helps us compare different types of investments, because one investment could be a 3-year investment, one could be a 2-year investment, one could be a 10-year investment. How do we compare the rates of return for different durations? We use the IRR to benchmark the return. The next thing that I want to cover is how long you invest, right? So that's covering what we just talked about. So the terms we use to refer to the length of time you invest are the tenure of an investment, or the investment horizon, or the holding period of an investment. So these terms all relate to how long you invest and what you invest in, right? So we're going to deal with this in the next class, but there are two primary types of investments that we're going to cover. equity or debt, right? And this also pertains to real estate also and all those things. I mean, these kind of investments capture most types of investments you see in the universe. So that's kind of the stage I'd like to set for our next class. So we'll end here and we'll open it up for Q&A.
Okay, so the first question that has come in is, if I invest in something and I redeem that investment and invest in another, let's say I'm in an equity mutual fund and I redeem and I put it into another equity mutual fund, do I lose the power of compounding?
Very good question. You don't lose the power of compounding. You may have some tax consequences and all of that, but let's ignore that for a second. You will not lose the power of compounding, because the key to the power of compounding is just that your savings grow every year, right? At a certain percentage point, right? And it doesn't need to even be a fixed percentage point. It just needs to keep growing at a certain percent every year, right? And let's say that I sell one investment and immediately reinvest it in another investment. Because that second investment is also going to grow, it will compound on my returns from the earlier investment. So don't worry about keeping it in one investment. You won't lose the power of compounding if you switch investments.
Okay, the next question. For a member, most of this is covered in Learn on the website. Is that correct?
Yes. Yeah, a lot of the content is there as well.
Okay. Real estate would be when you buy the house that you do not own, hoping that there will be an appreciation.
Correct. Yeah. So real estate, the investment is buying the house, right? And it's an investment because you expect the value of that house to go up over time.
All right. I don't think there are any more questions. Anyone watching this on the session, do you have a question? Otherwise, we'll wind up. I don't see anyone typing a question, so I think that's it for today.
Okay, great. So great. So the next class, we're going to focus on now using this framework where we're going to look at how do I figure out what the riskiness of something is, what the reward of something is, how do I compare investments, and we're going to lay the groundwork for that style of analysis. And what are some of the things that I need to think about before I put my money into an investment, right? So we're going to try to build on some of the tools we've used here. So great. Thank you, everybody. And I'll see you guys in 2 weeks as we continue on the series. Thanks. Bye.